Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I Tell.
All right. Yep, my name is Mark Eitel, and this is the Mr. Mortgage Show. And you, my friend, are in the right place if you want to walk away from the next hour with the data and the information that you need to make better real estate and mortgage decisions for you and your family. And there are a lot of articles floating around, a lot of data, a lot of headlines about real estate and mortgages. I mean, it was another interesting week. The Federal Reserve early in the week announced that they are most likely, I guess they didn't announce it. Let me rephrase that. The Fed minutes were read and deciphered, and it looks like we're in for some 50 basis point increases for the next few meetings. So no surprise to you if you listen to the show or follow us on Facebook, but it was newsworthy because a lot of people are concerned about what that's going to do to housing. And we're going to cover that in this show. So sit tight. We are definitely going to get to that because I think it's counter to what a lot of people believe is going to happen. So I do want to touch on that. But again, my name is Mark Eitel. This is the Mr. Mortgage Show. We're going to cover that and a lot more. If you have questions and you want them on the air, I encourage you to either call or text them to 561-291-8569. That's the Anytime hotline. That number again is 561-291-8569. I almost slipped and showed my age and said fax that number or fax your questions to that number. But anyway, call or text 561-291-8569, or you can send them to us through the website. There's a contact us box, and you can fill your question out there. A lot of people are more comfortable doing it that way, and the website address is www.mr.mortgage. That's mr.mortgage. And if any of this interests you and you want a deeper dive into the data and the reports that we use each week during the show, you'll be able to find those on the Facebook page. Just go to Facebook and type in the Mr. Mortgage Show, and we'll pop up, and all of this data will be there. Usually when we finish the show, I start uploading all the articles to the Facebook page. So with all that out of the way, let's jump right into this week's show. We mentioned there were a lot of interesting headlines this week, and I wanted to share one common conversation that seems to be swirling around right now. And a lot of people are looking to the government for solutions to housing. I mean, California right now is considering a 25% penalty tax on people who sell an investment. Actually, I think it's any property, but when it first came out, it was going to be for property investors. But if you sell the property within 7 years, there's up to 25%. And then as I read the proposed legislation, it steps down from the first couple years at 25%. But nonetheless, I mean, that's a huge penalty to pay for selling a piece of property when selling property right now is the problem, meaning there's not the inventory out there to meet the demand. So I wonder if, as well-intentioned as that piece of legislation may be, it may actually be counter to the problem and make it worse, because if you discourage people from selling properties for at least 7 years, logic kind of dictates they're just going to hold those properties and rent them out, which is going to bring less resale inventory to the market. So I find that interesting, and oftentimes the case with legislators. Their intent is to do the right thing, but they're not deep enough in the trenches and understand the problem well enough to make those decisions. So we're going to watch that and see what happens, but it's interesting that they're thinking that's the solution to the problem. Another thing that's been commonly thrown about is, a government grant for first-time home buyers, which is awesome, right? It's going to give them the down payment that they need to make the purchase. My fear with that is it's just going to increase purchase prices even more rapidly in that first-time buyer's market, because suddenly people are going to have the ability to buy that previously couldn't. But that might be a good thing. I'm not sure how that's going to work out. But here's an idea. How about if we cut taxes so that people have more spendable income at the end of the week, the month, the year? Because right now, as things become more and more expensive, income has been pinched more than ever before. And I found this interesting. I pulled an article from the Realtor.com website, and they talked about the lowest tax rate per state, and they had a list of the top 25 lowest taxes, and they took into consideration property taxes, sales tax, and income tax. And Alaska was number one which I found that super interesting. Wyoming was number 2. New Hampshire was number 3. Nevada was number 4. South Dakota was 5. And Florida was number 6. Tennessee, Washington, Texas, and Colorado round out the top 10. Now, in that list right there are 3 of the hottest real estate markets in the country. So that kind of dictates logically that lower taxes are more attractive, and it leaves you more of your income to use to buy real estate with at the end of your paycheck or your pay cycle. So I throw that out there. Maybe trimming taxes could be a start if the government wants to get involved and help people become homeowners. And it always becomes a topic around my inner circle, if you will, when we see these rapidly appreciating property cycles that we're in now, just like we saw 15, 17 years ago, that all of a sudden there's a very large, I don't know what the term I'm looking for, but falsely created tax base, if you will. Suddenly the house that was $200,000 taxable sells at $600,000, and now the tax rate on that property is reset at whatever, $500,000 after the exemptions. My point is that household of 3 people in that property had no more demand on the resources of the community than the new 3 people that lived there, yet the tax base just doubled. So what you typically see is, municipalities are going out there and leasing new equipment for their workforce, and the building department suddenly has brand new trucks. And yes, they may upgrade a park and, fix some of the infrastructure of the city, but it's never in direct proportion with the giant increase in taxes. And somebody's going to argue to me and say, well, what about new construction? They're adding people to the neighborhood, which is putting a burden on those infrastructure pieces that you just mentioned. Yes, in that case, there's what's called an impact fee that is part of the permit process, which is supposed to offset those 3 new people that are coming to the community. So I always find it interesting when we go through these appreciation spikes, what the municipalities do with all of that newfound tax wealth. And perhaps cutting taxes is somewhere that the government could look to make it more obtainable, homeownership more obtainable for a larger portion of the population. So I just throw that out there. There was another super interesting article. I'm going to touch on it now, and we'll dive deeper on it during the show. But it was the National Association of Realtors 2022 Trends and Outlook. And they've been doing this since, I think it's 2013. It's pretty interesting to look at the last, 9 or 10 years of the data. But they break all of us up into the age group. So we've got Gen Z, which is the 18 to 22-year-olds. They made up just 2% of both buyers and sellers, which is, you don't expect an 18 or 22-year-old to be participating in real estate yet. Awesome if they are, but, it wasn't surprising to see that number. Millennials making up the age group of 23 to 31, which they're calling younger millennials. And then the older millennials, 32 to 41-year-olds, they make up the largest growing share of home buyers at 43%. So I found that interesting, and that breaks down to 25% of the younger millennials and 18% of the older millennials. So that's a big portion of our buyers is that age group. As they're growing, their families are growing, they're growing professionally, they're out there, they're making up a big segment of that first-time buyer market. So super interesting. I'm going to post this on the Facebook page because I find a lot of the information in this interesting, and we'll dive deeper into that article during the show. But I just wanted to touch on it because we do post all this really great data in the Facebook page, and it goes to show you that the headlines alone aren't where you're going to find the answers. You really want to deep dive this data, because as we go through this article this week and we answer all your questions, I think you're going to find that there is far more demand in the market than supply, despite the recent increase in interest rates, which, oh, by the way, interest rates have stabilized over the last couple weeks. So I think the shock and awe of the initial interest rate jump is over. So we will be right back after this quick break. We're going to take 2 minutes and be right back with you on the other side of this. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back, and my name is Mark Eitel. This is the Mr. Mortgage Show, and you heard the announcer, 561-291-8569. 561-291-8569 is the anytime hotline. You can call or text your questions to that number. And Dom, my producer, is manning that question line, so we will get your questions answered right here, right now on the air. So I encourage you to do that, 561-291-8569. So I held up the article that I was referencing before the break to Dom, and it looks like a telephone book. And I'm not going to go through it because it is, I don't know, a couple hundred pages of data. And I'll post it up there for you on the Facebook page and let you kind of dissect it yourself. But I want to quickly touch some of the highlight points, and then I'm going to dive into your questions. So as I mentioned, Generation Z, which were the youngsters 18 to 22, made up just 2% of the activity. But millennials, which they're calling that group 23 to 41, made up the largest portion of home buyers at 43%. And surprisingly, the majority of those were first-time buyers. So I found that interesting because that age group is broader than I expected. I didn't realize that 43-year-olds were still millennials, making me feel old. But anyway, yeah, so that was fascinating. I mentioned that the first-time home buyer stat there. I'm just flipping through this real quick. They were also the largest portion of the married couple buyers at 64%, and they're moving up or moving out of their apartment as their family expands, and you'll see that in the article. They were also most likely to move directly from a family member's home, so check that. I might have that data wrong. Looks like they're moving out of mom's house and jumping right into their first home. Convenience to job and commuting was a big concern for them, and then the Gen Xers, which is 42 to 56, consisted of 22% of the market. So I'm not going to go through the rest of it because there's a ton of data there. But the reason I'm sharing this is there is still a tremendous amount of activity in a very large portion of our population that has a significant income. The most active members of society that are buying right now are also the highest earners. And they have less student loans than I anticipated. It was between $28,000 and $35,000. So student loans may be less of a problem than the news would have you think. So the reason I'm sharing that is if you're in a neighborhood and you're thinking of selling and your home is attractive to a younger family or a growing family, or you're in a neighborhood that might be attractive to someone who's older and downsizing, take some time and roll through that article, because I think the data will support that the activity is there and will most likely remain there for a while. Because as I mentioned last week and the week before, and probably since the beginning of time, supply and demand is what makes the difference in a market. And right now there's still so much demand, we don't have enough supply, that the interest rates alone aren't going to change that. So question time. I see Dom's got one teed up, so let me throw it over to him and see what we have.
This one's from last week. Jeremy sent it in. The company I work for was just bought by a competitor. I think they're going to keep me, but I'm nervous. I like to refinance and pay off my credit cards and the car. Can I still do it even though I've only worked for the new company for a few weeks?
Hey, that's a great question, Jeremy. And yeah, so here's the thing. You should be okay. I'm going to need a little more information, and I welcome you to call us during the week on the Anytime hotline, but you should be fine. I'd need to know how long you were with the previous company before they were acquired. But there's a process in the loan application called verification of employment, or VOE for short. And in that verification process, we as a lender, or you if you're already working with a lender, will contact your employer to confirm your employment status, your pay rate, but there's also the likelihood of continued employment is disclosed in that verification of employment too. So I say that you're most likely okay, because it's not like you switch careers, and this is completely unrelated. The company was sold, and if I'm understanding your question correctly, you are essentially in the same position. So yeah, I find that not to be a big challenge. I would just need to know how long you were with your current employer. And I commend you on looking at, kind of cashing out, paying down some debt, and, nestling in for this recession. We had a little bit of a boom lately in people considering refinancing, even though we're coming out of an all-time low interest rate environment. As the recession seems to get, more and more teeth, people are thinking it might be a good time to consolidate all their debt into one payment and put themselves and their family in the best position to weather a storm if it comes. So we also saw a little spike of pandemic refis when people were thinking they may lose their job because of vaccine mandates, and where they fell in the belief or the desire or the willingness to get vaccinated. There was a large portion of our society that stood to lose their job because of that. And we saw people doing exactly what you're talking about. They were paying off debt, pulling some cash out, and putting themselves in the best position to start over if they had to. Because, hey, guys, that's the reality. If you lose your job, you're not going to qualify for a mortgage then. If you really think something bad is going to happen, if this recession is going to impact you to that extent, and you're better served to make those moves now and prepare yourself for the storm. You don't go out in the middle of the hurricane and start putting up your shutters. So interesting question. I think you're going to be fine, but I welcome the opportunity to dive a little deeper with you on that. So let me throw it over to Dom and see if we have another one teed up.
Kim just called in asking, this may be a dumb question. I told her there's never a dumb question,
Perfect.
And she's asking, is there a maximum age for a mortgage? I'm 71, but I want a 30-year mortgage because of a low payment. Hey,
Kim, just like Dom said, there is never a dumb question in the mortgage world. And no, there is no maximum age on getting a mortgage. You could be 101 years old and take out a 30-year loan. And age is, you're not allowed to be discriminated against because of your age when being offered a mortgage. And the reality is, if you die with the mortgage and you leave the property to your children, they're going to pay the note off anyway, or they're going to sell the property, and that the note will be satisfied as liquidation of the estate. So there's not any risk on the lender's side of things. They're looking at your credit, your ability to repay, and then the value of the asset. So your age is not a qualifying criteria. So not a dumb question. And you would be surprised how many older people in our that we're seeing daily in our practice, because either in the reverse mortgage space that we talk about all the time, or they're doing refinancing and pulling some cash out for whatever reason, but they're taking advantage of all of this newfound equity to set themselves up for the next chapter. Maybe there's an investment opportunity. Maybe they're buying a rental property. I'm not sure, but we're seeing more and more of it. So that is not at all a dumb question. So speaking of questions, let me throw it over to Dom for another one.
Frank sent this email in. I'm commission only and get a 1099. My CPA is amazing and writes off everything he can, so my tax returns don't show much income. Can I use my bank statement option you talk about even though I'm technically not self-employed?
Hey, Frank, that is a good question. And it sounds like your CPA and my CPA are friends, or, they may be the same guy. So great question. And yes, you can use the bank statement program, even though you're not self-employed. Actually, a W-2 wage earner can even use that program if there were circumstances where maybe you had a side hustle that was cash deposits. I mean, we've actually had that circumstance where someone was, breeding exotic reptiles, and they were selling the reptiles for cash, and we used their bank statement income. But to answer your question, yes, you don't have to be quote unquote self-employed. There's also a 1099 only program that doesn't even involve bank statements. We're just looking at your 1099 income. And then lastly, I would encourage you to at least give your mortgage broker, or us, if you're not working with anybody, a look at your application, because there are a lot of write-offs we can add back in, because we know that they're just strategies to reduce taxes and depreciation. There are things like that can be written back in to your gross income. So to answer your question, bank statements will work, but I'd love a shot at getting you a conventional loan first. But you hear the music, that means we're rolling into another break, and we'll be right back with you in 2 very short minutes. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back, and you heard Mr. Announcer, 561-291-8569. We'll get your number, or we'll get your question on the air right now. That's the number that you need to call or text your questions to, 561-291-8569, or visit the website, www.mr.mortgage. That's mr.mortgagenever.com, or check out the Facebook page. Just go to Facebook and type in The Mr. Mortgage Show, and you'll find us there. So I see during the break that we've got some questions stacked up, so I'm going to try to motor through a few of them, and let me throw it right over to Dom and see what we have.
We just got another email from Dolores. Dolores was asking, we've used more of our savings on medical bills than we expected. I'm very concerned about the future, especially with inflation. We've cut back everywhere we can, but I'm not sure it's enough. Can you explain the reverse mortgage you talk about?
Hey, Dolores, I'm not going to skip through this one quickly because this is super important. But before I get started, I would love, love, love the opportunity to talk with you about this offline because I really feel like this is a huge decision for a lot of people, and it really, it deserves the attention that it needs to make you fully comfortable with it and to see if it's even right for you. I mean, I talked to a wonderful lady a couple weeks ago as a direct result of the show, and the reverse mortgage didn't make sense for her, and it was a fantastic conversation, and she's a super neat lady, but right now where she is in her life, it wasn't the right move. So I'd like to take that same time with you if you're interested, but let me give you an overview of the reverse mortgage. So and I guess I can use an example of one that we just got wrapped up this week. This particular couple, it was very similar based on your question. I'm assuming the similarities because there were some health concerns for the husband, and they used up a lot of their savings on some uninsured expenses. And they're concerned like everybody else. I mean, gas is, creeping up to near $5 a gallon, and they're feeling the pinch. So the reverse mortgage, what it did for them was allow them to pay off their current mortgage, and they were making a monthly payment of, I think it was around $1,600 a month, principal, interest, taxes, and insurance each month, and that was coming out of their, their retirement income and their Social Security, and it was becoming a pinch with all of the additional expenses. And as you mentioned in your question, that you spent a little more of your savings than you wanted to, they did the same thing. So what the reverse mortgage allowed them to do is pay that first mortgage off so they no longer have that payment. And at closing, and we didn't close it yet, we just got it wrapped up this week, it'll close next week, they're going to get access to some of the funds immediately. And I believe they're going to take around $20,000 at closing. And then after the first year, so the beginning of month 13, they'll have access to a credit line that they can draw against as long as that balance remains positive, the credit line balance. So it pays off the mortgage. There's no more mortgage payment at all, ever again. They do have to pay their taxes and their insurance, and there are some minimum insurance requirements because there is still a mortgage on the property. It's just a reverse mortgage. They're getting a lump sum just after closing, and then access to the credit line for the remainder of their lives as long as they don't spend all of the credit line. Now, they can make payments against that credit line later and have it available again if they need it. But the reverse mortgage is designed to take the pressure of the monthly expenses off your plate and allow you to access your equity in the form of income. And it can be a monthly payment that you receive from the reverse mortgage, or you can do as this couple's doing, where they're taking a chunk just after closing, and then they have access to the credit line from that point forward. So a lot of the common questions are, what happens to the property when we pass away? Your children or whoever you leave the property to inherit it, and then they just have to satisfy the mortgage. Just like I think it was a question or two ago, an older woman asked if she got a mortgage, what would happen? And it's the same thing. There's just a lien on the property. There's a mortgage lien, and your heirs will have to satisfy that. And one of the cool things is it doesn't matter which one of you goes first. The other surviving spouse can remain in the property until they pass away as well. So it's ideal if you're in the home you want to remain in, you want to age in place, and you have no short-term aspirations of going anywhere. If you do change your mind and you want to sell or go into an assisted living facility or a 55 neighborhood, you can do that. There's no prepayment penalty. There's no restrictions on selling the property. So it's an amazing loan program. It's not for everybody. It truly isn't. As I mentioned, the woman that I spoke with a couple weeks ago. But if it's right for you, it can certainly be life-changing. So I hope that helps. I would really welcome the opportunity to dive deeper with you off the air regarding this because, as I mentioned, it really requires a lot of attention. There's a ton of questions that'll come up during conversation. So if you're interested in that conversation, just give us a call, 561-291-8569. That's the Anytime hotline. It rings right here, right now when Dom and I are in the studio. but it also pushes to my office during the week. So hopefully that helps, and I'm happy to give you any advice, suggestions, or guidance that you're interested in. So anyway, let me throw it over to Dom and see if we have another question teed up.
Jeffrey sent in this question. He's asking, I think it was last week you talked about parents giving money to their kids for a down payment. Does it have to be a parent, or could someone else give the down payment money to you?
Hey, Jeffrey, that's a great question. So it doesn't have to be a parent. It just happens to be most often the parent. And that big, gigantic phone book length article that I was reading in the opening segment, I think it says somewhere in there that 29% of the Gen X buyers, or millennial buyers rather, received a gift from their parents. But anyway, it doesn't have to be a parent. Think blood relative or spouse. So it can be a brother, a cousin, blood relative. It could be a spouse. It could be your brother-in-law. It could be a relative by marriage. Fiance, domestic partner, but not a parent. It can be a parent. It just doesn't have to be a parent. In some instances, it can also be your employer. Most of the time, that's surrounding a relocation. But think family member or someone that your fiance or relative by marriage is typically the broadest group of people that you can receive a gift from. There are some other circumstances. It can be a grant sometimes. And I'm happy to send you a full list. Actually, you know what? I'll put that up on the Facebook page too. How about that? I'll put up a full list of Fannie, Freddie, and FHA approved gift sources and see if that helps. And you can find that at Facebook by just searching The Mr. Mortgage Show. So let me throw it over to Dom and see what else we have.
We just got this text from Scott. Scott's asking, can I get a regular mortgage on a manufactured house? I'm getting mixed messages from the people I've talked with. Is this something you can help with?
Hey, Scott. Yeah, we can help with it. And the answer is yes, yes, and yes. And why 3 yeses? Because you can do an FHA, you can do a VA loan, or a conventional loan on a manufactured house. And I mean, as house prices have soared in the last couple years, manufactured housing is what a lot of people are looking to as an affordable option. Now, there are 2 big caveats. I was going to say there's one, but there are actually 2. The big caveat number 1 is the age of the structure. So there were changes in the manufacturing process and the documentation of manufacturing in the summer of 1976. So I believe, don't quote me on this, but I believe it was July of 76. So I always say, to play it safe, 1977 or newer. The structure has to be 1977 or newer, and you have to be buying the property, the dirt, if you will, at the same time. So if you're in a co-op or a quote-unquote trailer park, and I'm using air quotes, usually a co-op is a different animal. I'm not going to go down that road. But with a trailer park, you don't own the land, you pay lot rent. That's a different type of loan. But if the dirt is part of the deal, then FHA, VA, or conventional are available all day. And they're getting expensive. I said it's an affordable option, but we just did one in Hobe Sound that was $250,000, and we helped a first-time home buyer with an FHA loan in Okeechobee for, I believe it was $130 or $140. So they're even creeping up there price-wise. But anyway, I hope that helps. And yes, that is something that we can help you with. We'd be happy to do it. Happy to answer any questions you have. So you hear the music. That means we're going to roll into another break, and we will be right back with more of your questions on the other side of this 2-minute break. And you can get those questions to us at 561-291-8569. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the rec loan he advertises. Long story short, we did a rec refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Dom, my producer, and I do this every weekend right here, same time, same station. So thank you for joining us. And if you'd like to get your questions on the line, go ahead and shoot them to us via text or give us a call at 561-291-8569 or hit the website www.mr.mortgage and you can submit your questions there. Remember, there's never a .com, just mr.mortgage. So I want to keep the questions rolling. I see we got a few stacked up in the queue here. So let me throw it over to Dom and see what we have.
Marilyn emailed this one in. We've made several offers and keep missing out. Our realtor is telling us it's because we're FHA. This makes no sense to me. Why should the seller care? Money is money, right? Can you explain why FHA is bad for the seller?
Hey, Marilyn, man, I feel for you. I really do. And you're right. Money is money, and the seller should not care. There's no shame in FHA, and an approval is an approval, assuming that you are approved by a lender with a good reputation, and they've run you completely through the underwriting, and they know any problems that would arise have already been addressed. You're absolutely right to be frustrated. A seller should have no hesitation with FHA. And I think where it all started was there's an addendum in a real estate contract that's going to involve VA or FHA financing that allows the buyer to cancel the contract if the property doesn't appraise. So as we moved into this crazy, rapidly appreciating cycle, people were willing to pay more than the property was listed for and even more than it was worth because they were so eager to buy a property. And a lot of people got in the habit of waiving appraisals. And if you've listened to this show for any amount of time, you know I'm not a fan of waiving any of your rights when you're entering into one of the largest purchases you'll ever make in your life. So because of that appraisal circumstance with you having the right to cancel if it didn't appraise. Now, that being said, you can still move forward if you elect to, but I think the appraisal side of it became what made it less desirable, if you will. And if you ask the average real estate agent, what's bad about FHA, almost always they're going to answer appraisal without really understanding why they're even answering it. So I believe that's the circumstance that's probably tainted them. But yes, FHA there's absolutely no problem with it, no shame with it, as long as the property meets all of the requirements of FHA. And it's truly a mindset. I mean, I work with some agents who are getting FHA contracts accepted all the time, and I'm working with some other agents who are having a hard time getting them accepted. And sometimes it's how they're presented and the mindset surrounding the loan program. So hang in there. If you have questions or you ever want a second opinion or you want some advice outside of that, just give us a shout, 561-291-8569. Hope that helps, but definitely hang in there because no shame in the FHA game. And as the market continues to transition a bit, I think you're going to find sellers more willing to accept those offers anyway. So hang in there, Marilyn. Hey, Dom, what else do we have?
We just got this text from Susie. She's asking, we have 7 months left in our lease and are trying to look at houses. Every realtor we talk to wants us to get approved for a mortgage first. We just want to look and don't have to have our credit pulled before we're ready. I don't want to lower my credit score. Is there any way around this?
Hey, Susie, that's another byproduct of this market we're in. You know, recently it's become standard practice that you're not even looking at a property without a pre-approval. And in the old days, you looked at a property and then went out and got your mortgage approval. And then we started a process called pre-qualified, where we would give you kind of a very general look over, if you will. And we would talk about income, talk about credit scores, talk about assets without verifying anything, and let you know that, yes, you are pre-qualified, different than pre-approved, for around a certain price range. So because the market's gotten so hot, everybody wants, you know, I guess if you're going to go hunting, you're going to want your gun and your bullets. But I get it. You just want to start the process. You're curious to see what's out there. So to answer your question, we have an approval process that involves a soft credit pull, which does not reduce your credit score. And it gives us enough of a look at your credit to know if you are going to be qualified. And then with your income and asset documentation, we have a very good idea to know if you're going to be approved. So that's what's called a soft pull approval. And that's available. If it's not available with the lender that you or your agent is working with, we would be happy to help. But maybe that's kind of the happy medium between your agent looking for an approval and you wanting to now start the process 7 months out. And hey, by the way, that's a wonderful time to start because it gives you time to really feel out the market and get a feel for the neighborhoods that you want to be in. And I think that you've started the process in plenty of time to get something done. So hopefully that helps. But we're going to keep the questions coming in and see what Dom has for us.
John sent this one in. Not sure I'm asking this the right way, but my wife's credit is better than mine. Can she be the only one on the loan and both of us still be on the deed? I earned the money and she has the credit.
Hey, John. So that's a great question. There's two. So the last sentence of that question kind of throws a question that I have for you out, but I'm going to answer your question first. Yes, one of you can be on the mortgage and both of you can be on the deed. And it's not uncommon. It truly isn't for one, either husband or wife, to have the stronger credit. And we many times will do the loan application in just one party's name, even though more than one party are going to be on the deed. Now, here's the thing that not a red flag, but just a question that I would have to ask. You said at the end, if I'm paraphrasing this correctly, that she has the credit, but you have the income. Now, if that's the case, it's maybe a bit more challenging because she's going to be on the loan application herself. She's going to have to stand on her own income-wise as well as credit-wise. So I would need to know a little bit more around your personal circumstance, but assuming that her income would also support the debt because you mentioned she has the good credit, then yes, you have an opportunity to do this. But if she's not earning income and you are, you're most likely going to both have to be on the loan. And I would also be curious to know how bad, and I'm not saying bad in a judgmental way, but what your credit score is and what your hesitation is in thinking that you wouldn't qualify as the two of you on the loan anyway. So I would welcome the opportunity to kind of take a look at your personal circumstance and see if there may be a way to work with both of you on there if she truly doesn't have the income. But to answer your question, yes, one person can be on the loan and then two people on the deed. So hopefully that helps. If you want to dive deeper on that, just give us a shout off the air and I'll be happy to talk to you about it. So let me throw it over to Dom and see if we have another question.
Lisa emailed us this one. We're ready to move, but are hesitant to sell before we find a house. We're thinking of taking out a HELOC to use as a down payment. Is this a good idea?
Hey, that's a great idea. It's a HELOC. But yeah, so here's the thing. A lot of people do that, right? You'll take a HELOC out and you'll use the HELOC for your down payment on your new property. Now, the caveat is you're going to have to qualify for both mortgages and the HELOC as well as all your other debt. And I'm teasing Dom calling it a HELOC, but it stands for Home Equity Line of Credit. And that's going to be more debt. And then your current mortgage, and then the new mortgage, all of that is going to have to be supported by your income, and your debt-to-income ratio is going to have to be able to carry all of that. So assuming that's the case, then yes, that's that's an idea that would work. I would also caution you to look at the terms of the HELOC and see if there's an early termination fee, because oftentimes there's no or very little fees on the front of getting a home equity line of credit, but there may be an early termination fee, which might want you to rethink the actual cost associated with doing it. But assuming that you carry the debt and that works financially, then yes, you can do that. I would caution you to use a HELOC if you plan on keeping your current property and renting it, because there is some occupancy disclosures, and a HELOC is usually only allowed on your primary residence. And if you plan on keeping it and renting it out, that might pose a problem down the road. So hopefully that helps. I have one other thing I'm going to throw at you on the other side of this break, but you hear the music playing. That means we're heading into a 2-minute break. So hang in there with us for 2 short minutes, and on the other side of this break, we'll continue to answer your questions. If you have questions, shoot them to 561-291-8569.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to Mark Eitel and the Mr. Mortgage team.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com. Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, we are back. My name is Mark Eitel. This is the Mr. Mortgage Show, and if you have questions, call or text them to 561-291-8569, and Dom will get your question on the air. Now, to wrap my thoughts up regarding that question that Lisa had on the front end of this break was taking a HELOC out to use as a down payment. Now, if any of those caveats that I mentioned in that strategy don't seem to make sense for you personally, there's a new program that we just got approved for. It's called Offer Like Cash. And if you're approved for your mortgage, you can go out there and make essentially a cash offer with no contingencies other than appraisal and inspection. And if you don't sell your property in time, they'll buy the new property for cash and then sell it back to you within 6 months at the same price that you had it under contract for the first time. Now, there is a fee associated with it, and it ranges between 1 and 2.75%, but it's an interesting option for somebody who wants to go out there and buy first and sell later because they don't want to be homeless during this transition. So I throw that out. That's a whole show on itself, on its own rather. It's called Offer Like Cash. I'll be happy to, actually maybe next week we'll go in deeper on that because it's a cool new program. But if you have questions around that, I'll be happy to address it. So anyway, let's throw it over to Dom for another question.
We just got this one from Sam. Sam's asking, I'm seeing low rates being advertised on Facebook. They seem too good to be true, but the ads keep popping up. What's the catch?
Points. Sam, points. So a lot of those low rates, there's a big fee associated with getting that low rate. Because the reality is you can have a low rate right now today with anybody if you're willing to buy the rate down in the form of discount points. So read the fine print. And you know what? If there's a particular ad that keeps popping up, tag me in it. I'd love to see it. I'll give them a call and walk them through the program and get down to the brass tacks with them and see what's really up. But points is usually the case. It's a clickbait ad just to get you on the phone, and then you'll usually get the real info from there. So hopefully that helps. But hey, I want to thank everybody. We've had some amazing questions so far, and I'm really happy with the feedback that we get during the week on the Facebook page. And I encourage everybody to hit that Facebook page. Just go to Facebook and type in The Mr. Mortgage Show. We're dumping all of these articles and all of the data that I use to answer your questions on that page so you can get more information. And you hear me say it all the time. Read past the headlines, dig deep into the data to see the truth. And our goal is always to give you the information that you need to make better real estate and mortgage decisions for you and your family. Whether we are helping you or not, our goal is to give you those answers. So hopefully we're doing that for you. And I have a favor to ask. If you've enjoyed the show or you found any of this valuable, please share it. We're always trying to grow our audience. We're on all the podcast networks. You can just Google The Mr. Mortgage Show if you want to send a link to somebody that you think will benefit from some of the information that we cover on each episode. And then the Facebook page is another great place to share. But we're always trying to grow the audience, so we definitely appreciate your shares. And as I mentioned, we're going to continue to just, whatever questions you have, continue to answer those for you here on the air. And we encourage those, 561-291-8569. And then lastly, if you know anybody or you hear a conversation at Publix or at work or in the elevator, someone who's thinking of, buying or selling or refinancing some real estate, or they have questions, introduce them to the show also. I'd be happy to answer their questions. So yep, that's all I got. That was my ask. Please share the show. Please spread the word for us because we certainly enjoy having your questions each week on the show. And I'm really enjoying all the interaction on Facebook. A lot of people are DMing me, and I'm an old dog, but I'm learning new tricks, and I'm having some pretty interesting conversations around all that. So in summary, what I'd like to share with you is that the market is still good. It's scary. Prices have certainly increased quickly. We've gotten to a place that's difficult for a lot of people to make that decision, but don't let the headlines scare you. Supply and demand make all the difference in the world, and the Facebook page has the supply and demand video up there too. So anyway, 561-291-8569 is the way to catch us during the week. Visit the website, www.mr.mortgage. That's mr.mortgagenever.com. And Dom and I will see you right here next week. Have a great week.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.